tax efficient strategies for property investors. If you're looking for lucrative strategies to invest your money in, then try the real estate industry. You can build houses and rent them out for income. Additionally, you can sell your properties after some time. If you do proper maintenance on them, they'll eventually be more valuable. You will thus end you will thus end up bagging more money than what you initially spent on the purchase of the properties. However, to reap the maximum from your investment, you should familiarize yourself with the rules of the industry. Determine the projects and moves that will bring you more income and which ones will empty your pockets. Taxes, for instance, have a way of slashing your total income to shocking levels if not properly managed. They might leave you in losses from an investment you thought would be more would, would be the most profitable. On this account, this article discusses several strategies you may put in place to ensure that you pay the government its duties as efficiently as possible, hence achieving the most of your property investment. Read on to learn more. Number 1. Apply the 1031 exchange. 1031 exchange derives its name from section 1031 of the Internal Revenue Code. If you are a property owner, it allows you to postpone paying your taxes for an unspecified amount of time. This, however, should be on the condition that you buy a similar property with the profits incurred from your first property investment. A 1031 exchange scenario may work like this. You buy a house worth 200,000 US dollars and spend an additional 50,000 US dollars on improvement and maintenance. Afterward, you sell it at 300,000 US dollars. You have earned a profit of 50,000 US dollars. Now, you may choose to spend this profit on a new set of furniture and jewelry somewhere and get taxed for them. Alternatively, you could defer your taxes for a while with 1031 exchange services. For this, you need to invest the profits on a similar house project. For instance, by using the profits as a down payment for another house, you would not be taxed for this. Thus, you'll save yourself a significant amount of money. Number 2, use seller financing. Simply put, seller financing is where you handle the mortgage process of the buyer. Instead of them using traditional financial institutions, they'll pay you directly in installments. So, when paying for income tax from the sale, you will only pay a percentage of the down payment from the buyer, and you can complete the remainder over time with every installment from the buyer. However, this can be risky in the event where the buyer defaults in their payment. You therefore have to thoroughly vet the buyer before agreeing to enter an installment sale. You can do this by a lease purchase agreement where the buyer will first start by renting the house, with part of the rent proceeding to down payment of the house. When a certain deposit amount is reached, you can transfer full ownership of the property to the tenant and close the deal with a mortgage note. Third, own properties for longer than a year. If you plan on buying properties and selling them for a profit later on, otherwise known as flipping, you are recommended to do so after at least a year of purchase. This is because by flipping your properties within the year of purchase, the government will tax you at your normal income tax rate. The Internal Revenue Service (IRS) may even classify you as a self-employed dealer, and you will end up paying double the tax rates. However, if you own the properties for more than a year, you will be taxed based on capital gains, whose rates are way lower than income tax rates. If you have to flip the properties, however, you can rent them for a year or more before selling them. Here, you will not only have decreased your tax rates, but you will also get extra income from the leasing. Number 4, maximize your deductions. One of the many plus sides of property investment is its intensible room for tax deductions, especially if you are renting your house. Some notable deductions include insurance. Deductible areas may include theft, fire, flood, or landlord liability insurance. If you have employees, the health and workers' compensation insurance can also add to the deductions. Interest. These include mortgage interest payments on loans used to buy or renovate your property. It could also be interest from goods and services used in rental activities. Travel. You are entitled to a tax deduction of your travel expenses which you use for rental activities. For instance, from the gas money and all other travel expenses you use when you go to a hardware store to buy equipment used to repair a tenant's house. Legal fees. As long as the fees are paid for work related to your rental activity, you can deduct them from services from your attorneys, accountants, property investment advisors, and other expert service providers. They are just some of the deductions you can claim to minimize your tax bills. For more of them, and if you need further clarity, you can speak to your accountant who will shed some more light on this. Number 5, steer clear of double FICA taxes. These are taxes designed for Medicare and Social Security, combined with local, state, and federal taxes. FICA taxes sum up to a tax rate of 15.3%. If you are employed, your employer shares half of the taxes. However, if you are self-employed, you will be responsible for the whole 15.3%. Therefore, as mentioned earlier, if you flip property in the same year of buying, IRS may classify you as a self-employed dealer. To, av- to avoid the FICA taxes, you could state you could state in your records that property sales isn't among your regular business practices, but rather it's a means for you to generate capital for other investments, such as paying to renovate other assets or making a deposit for a rental investment property. Sixth, borrow, don't sell. Over time, your property appreciates. You may choose to sell it, but you'll have to pay for property gain taxes. Alternatively, you can rent it and borrow money against it, and you won't have to pay any taxes. Over time, you can pay the loan back from the rental income from your tenants, and you will get to keep the property, which will continue appreciating if under proper maintenance. Number 7, depreciating your property values. The IRS set the lifespan of a residential building to 27.5 years. Therefore, you can deduct one of over 27.5 of your total tax for the construction projects in your property every year for the first 27.5 years. You can also apply this to individual capital improvements on your building, for instance, on repair and maintenance costs, such as installing new roofs, railings, or windows on your building. Utilize the, Number 8, utilize the 20% pass-through deduction. This deduction plan was incorporated in the Tax Cuts and Jobs Act of 2017. It applies to small business owners, including property investors. With this, you'll be able to deduct an extra 20% from your net business income. However, the process may seem slightly baffling, especially if you lack sufficient experience in handling taxes. For this reason, you can hire an accountant who will help clarify what's involved in this process. Number 9, use a self-directed IRA. Individual retirement accounts IRAs are retirement plans that postpone tax payments for their users. Therefore, they are an efficient way to invest for retirement. On this basis, you can set up your own self-directed IRA, which should use as a tax-free method for your property investment. The process is, however, a bit complex as to begin with. You are required to hire a custodian to oversee the self-directed IRA process for you. They'll create they'll create the self-directed IRA where you will be transferring your money. You can then create a liability company to buy and own the investment properties. The self-directed IRA will then invest the money into the limited company. However, before setting up a self-directed IRA, ensure to conduct thorough research on the process entailed and hire reliable custodians. Number 10, own your properties to the end. Well, this will be more beneficial to your heirs. If you die owning property, the acquisition cost is done away with and your heirs pay no capital gains. You can lease the property and keep pocketing the rent. If you need some more cash, you could borrow against the property instead of selling it, as explained above. When you die, your inheritors get to own or sell the property tax free, as they won't be required to pay capital gains. Conclusion. Property investment is a beneficial way to utilize your money. However, it can be expensive, especially if taxes aren't carefully managed. This article has highlighted 10 methods you can use to ensure you comply with the government's tax paying system while paying the least amount of tax. This could be through 1031 exchange services, selling your property in installments, owning property for more than a year, avoiding double FICA taxes, setting up a self-directed IRA, borrowing money instead of selling your property, maximizing your deductions, and for the love of your inheritors, owning your property till the end of your life. If you utilize these tax-efficient tips, you'll surely be a step ahead at saving, and you can invest even more on other properties and be more profitable.